Hey, what's going on, everybody? This is Yusef Scott and baby girl Genesis. I wanted to let you guys know that we're thankful for you guys being here with us today. Those of you all over the world who have subscribed to my channel, those of you who are loyal to watch my videos each and every day that I put out content, and most of all, those of you who are just finding Forex for the first time and you're just starting on your Forex journey, you're going to need a place where you can hone in and get great information, and what better than the So Darn Easy Forex movement. Now I want to let you guys know, if you have not yet subscribed to this channel, please do so you can stay abreast of all the current content, have it delivered to your mobile device. You can watch it like that. Alright, now I want to let you guys know that basically this video is going to be about keeping your trading gap small. Alright, I'm going to explain exactly what a trading gap is. I'm going to explain exactly what happens when you keep it large and just what happens in general. Alright, so basically I remember when I just got started trading Forex, and of course I was like most people, when you start you don't know what you're doing. You're playing around, you're opening up trades, closing them. But once you start to become familiar with how to trade, you learn a little bit by little bit. I remember placing trades, and when the market just hammer against me, when it goes against me, I panic. And then I put in a trade going in the opposite direction, provided your broker allow you to do so. A lot of your brokers who are regulated will not allow such trading, called hedging. So having the ability to put in a sell when my buy was in the negative, I just panicked. Put in the trade in the opposite direction, and there you have it. Now you're playing both sides. And one of the stories that I've mentioned before was how I started out with $500 some in my account. The first time I ever traded, I had traded within 30-45 minutes, had it up to 1,800. The next 30 to 45 minutes, I lost at 1,300, back down to 500. By the next morning, my account was totally wiped out. Maybe a few dollars left after getting margin call. Bless you, bless you. So, so basically, what happens all too often is we're in on a trade. All right, let's say you're in on a sell, and the sell is in your favor. All right, and all of a sudden you turn back around and you look, and your trade is in the negative. So what happens all too often to traders is, instead of them taking the money when they see that the market is pulling back against them, they'll let the trade go into the negative. And then if your trade is here, all right, if your trade is here, and then you see that your trade was up here, and you see that this is where you entered, your trade is up here in profit, you see that your profit is dwindling away, and then all of a sudden you're at break even, and now you're in a negative. What will happen is that gap becomes wider and wider. All right, and most traders, what they would do is let that trade keep running, expecting it to turn around, but not knowing that they just made a bad entry. That's the problem. Your entry is bad. So if one, your entry is bad. Two, while you were in the profit, all right, well, it can be one or the other. Either your entry is bad, or while you were in the profit, you didn't take your profit. You allowed the market to pull against you, and now you're in the negative. And then you're sitting there hoping and praying that the market will turn around, and there's no guarantee of it turning around. So if you entered here and you see that your money is up here, you're in the profit, you see that it's pulling against you, take your money. Don't allow it to keep pulling against you. If anything, take profit with $1, $5. It's better than losing 200 or 300. All right, because if you see your money dwindling away, then you're at break even, and then it's going in a negative. The best thing to do, if you think that, okay, maybe it'll turn around, you have to have some sort of idea in your mind. Okay, I don't want to lose no more than $5 or $10. Let me shut this trade down. Shut your trade down. Some of you use stop losses, whatever. I'm one, I don't use a stop loss. I will watch my trade, and if it's at a point where I can't handle it, just shut it down. You know, but it all boils down to your entry. Did you have a good entry? If you had a bad entry, it will be screwed up from the floor from the beginning. But if for some reason you were in the profit and you allowed your profit to just dwindle away without taking your money, that's on you. You should have taken your money before it hit zero. Then once you're in the negative, you cannot expect it to turn around. If you're not analyzing the market properly to know that, you know what, I've made a bad choice, then you don't know when it's going to turn around because you haven't properly analyzed the market. So if for some reason you're in on a negative trade, you entered here and you're in a negative down here, and this gap is only $10. The further away, the higher the negative gap is. If you were to make the gap this wide opposed to this, at this, with this depth of negative equity on your account, it could throw you out of the market. So keep your gap as small as possible. Do not let that negative gap widen, because one, it's going to decrease your margin level percentage, and two, it's going to be hard for you to get out of those trades. You know, so hopefully this video has taught you guys. Hopefully you could you know, see exactly what it is that I'm referring to in your mind. What are you doing? Thank you. And you're able to use this as a way for you to make better trades. You know, yes. Let me see. Put your shoe on. Put your slipper on. All right. So hopefully you guys can use this as a tool just to think about when you're trading, so that you can make better decisions if your trade go against you. Because it's nothing like having a couple $100s in your account, and then if you're trading too heavy to begin with, I mean, your account could be upside down quickly. But let's just say you're trading too heavy and you realize that, man, I was once $20 in a profit, now I'm down to 2 or 3. Let me just take this real quick, because it could be disastrous. So that's what you do. Take your money, or if you're in the negative, shut it down as quickly as possible so that you can avoid any further negative equity on your account. Oh, just play with your iPad. Alright, so you guys use that to your advantage. I would hope that you guys would you know, adhere to this video and make sense out of it, because it's definitely something that can help you. I've been there too. You're not alone where, you know, the market might go against you and you fail to shut down your trade, and it's just, the gap is really wide. The best thing to do is to shut it down to incur less negative equity. All right, it's better to have a $300 account, and then for the market to go against you, maybe 5 or 10 pips, or let's say $5 or $10, and you give up, you know, $5 or $10 out of the 300, opposed to allowing it to go all the way down to like $100 negative, where a third of your account is gone, and you have to try to, in your mind, you're fighting, trying to make up the 100, chasing your negative equity. You know, it's better to just shut it down and start over a new clean slate with 290, you know, than to have to lose a 30 account and only have 200, and in the back of your mind now you're thinking, man, I'm a failure, I'm this, I'm that, kicking yourself in the butt because you let $100 go, you know, be taken out of your account. All right, it's better to lose 5 or 10 than to lose a whole 30 of your account, a large lump sum of your account. All right, so you guys have a fantastic day. Look forward to speaking to you all soon. Peace. Say peace. All right, Genesis is into her iPad, so she's doing her thing. So we'll talk to you guys soon. All right, peace. Have a wonderful day.